Okay, so let's jump right into it. You've probably heard this term CBDC being thrown around a lot lately, usually in the same conversation as crypto and stablecoins. But what exactly is a central bank digital currency? Well, that's what we're going to break down right now. I mean, think about it for a second. Every time you tap your card at a store or send money with an app on your phone, you're using digital money. But here's the thing, that money is technically a liability of your commercial bank. It's a promise from them to you. A CBDC flips that whole idea on its head, and it raises some really big questions about what our wallets are going to look like in the future. So here's the official definition. A CBDC is a brand new type of money. It's purely digital, and it's issued by the government's central bank. Now, the most important part of that sentence is the phrase direct liability. This means your money is a direct claim on the central bank itself, just like the physical cash you might have in your pocket. It's not a claim on a private company like Chase or Bank of America. This is probably the simplest and best way to think about it. Just imagine a dollar bill. But instead of being a piece of paper, it's a secure piece of code that lives in a digital wallet on your phone. It has the exact same value, the same trust, and the same full backing of the government. It's basically the digital twin of the cash we've been using for centuries.
Okay, now this is where things get really interesting. You see, to truly understand what a CBDC is, you have to understand what it isn't. So let's put it head to head with the other kinds of digital money that are out there.
This table really lays it all out. Let's just walk through it. Take a look at the issuer row. For cryptocurrencies like Bitcoin, there is no central issuer. It's decentralized. For stablecoins, they're usually issued by private companies. And then you have these decentralized stablecoins, which are often run by something called a DAO, basically a group that's governed by code and community votes. But a CBDC, that's issued directly by the central bank. And that right there directly affects the trust model. With crypto, you have to trust the code. With a stablecoin, you have to trust the private company. But with a CBDC, you're putting your trust in the government itself.
Let's just zero in on that liability point one more time because it's so important. The money sitting in your bank account today is a promise from a private company. That means it has what's called credit risk or liquidity risk. What if the bank gets into trouble? It's the whole reason we have things like deposit insurance. A CBDC, on the other hand, as a direct liability of the government, would be completely, totally free of that kind of risk.
And the difference in stability? Well, it's just night and day. A CBDC would always be worth $1 because it is a digital dollar. Its value is completely anchored. Cryptocurrencies, on the other hand, get their value from speculation, from supply and demand, which is exactly why we see those wild roller coaster price swings. They're just fundamentally different things.
So now we know what a CBDC is and how it's different from everything else. But that begs the question, why are more than 100 countries all over the world suddenly looking into these? Let's get into the real strategy behind this huge global push.
It really boils down to three big reasons. First, they want to improve our payment systems. A CBDC could be a new, super efficient public option that drives competition and innovation. Second, it could be huge for financial inclusion. It could give people who don't have a bank account a safe and really easy way to get into the digital economy. And third, and this is a big one, it's about maintaining monetary sovereignty. They're worried that a private stablecoin could get so big that it operates outside of the government's control.
Now, there's another idea floating around. It's a bit more futuristic and, frankly, a little controversial. In the future, a CBDC could give governments a powerful new toolkit for monetary policy. Just imagine if they could send stimulus payments directly into every single person's digital wallet, instantly. It's mostly a theory for now, but it gives you a sense of the kind of power this technology could unlock. So, after looking at the technology, the comparisons, and the reasons why, what does this all boil down to? When you strip everything else away, it all comes down to a single fundamental concept that sits at the very heart of money and finance. This is the key takeaway. The whole debate, crypto versus stablecoins versus CBDCs, is really a debate about where we choose to place our trust. Do you trust decentralized code and a network of computers? Do you trust a private company and its auditors? Or do you trust the long-standing institution of a country's central bank and its government? Each one requires a different kind of faith. Now, from the perspective of a central banker, the choice is crystal clear. This quote right here really sums up their entire argument. Because a CBDC is a direct IOU from the state itself, it has zero private sector risk. In their eyes, it is the absolute bedrock of safety in an increasingly digital world. And that really leaves us with the ultimate question, doesn't it? The shift to digital money isn't an if, it's a when. It's already happening. But what form it will take is still very much up for grabs. Will our financial future be built by decentralized networks, by giant tech companies, or by the state itself? As our money goes digital, figuring out who's in the driver's seat, well, that's the real challenge we're all going to have to face.